The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The S&P finally breaks out of that trading range. Unfortunately, it's to the downside. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. The S&P 500 on its third day of losses, the longest retreat in almost 7 weeks. And leading the declines is really the Magnificent Seven, as Tesla, which is the only member of that group, not up on the year, reports earnings after the close. The group is still not far off from 3-month highs, we should know. The 10-year yield did get to as high as 4.26% as we continue to see this repricing of the Fed's rate cut path, which is now seen as less aggressive than before, and dollar strength all around. Really, it's the yen as the biggest decliner among G10 currencies, getting to that level where people are wondering whether Japanese authorities might intervene.
Stocks right now near those session lows, setting up for what could be one of the worst days we've seen in more than a month. And it's on days like today where it's always good to remind folks that this is indeed a market of stocks rather than a stock market. And there are some bright spots to be found if you're willing to look. But those bright spots, they are tethered to positive earnings reports that are being increasingly rewarded more significantly this season as Wall Street strategists say the slew of upside earnings revisions, that's going to lend some support to those banking on a resumption of the equity rally and a resumption of that cyclical rotation.
What we're anticipating is a broadening of the market, the relative performance of the typical stock versus an aggregate index. What we're focusing on is a strategy for how to perform well.
And that strategy may pay off long term, but unfortunately, we're not seeing that today or yesterday or Monday. And we may not even see it until after Election Tuesday on November 5th. That's because right now, a lot of short-term traders and long-term investors are reluctant to do anything, to rotate, to oscillate, even vacillate. No big wagers for a while as political risk looms and the economic picture remains far too layered to be certain of anything. And in fact, that's a big reason why that this tight trading range that the S&P had been mired in for the past month has finally broken to the downside. The S&P, which yesterday had its first back-to-back daily declines in 6 weeks, is now poised to do something it hasn't done in 5, and that's close out the day, Scarlett, with a move of 1% lower.
I know, it's been a rarity, right?
Yeah.
Well, what the thing is, big tech is a big reason why the S&P 500 is down so much today. But we've seen a recent shift away from tech of late, and that has served as both, of course, a safe haven and a play on growth. If you look at cyclicals, which don't include big tech, compared with defensives, that is the white line here. It's been moving up this year in 2024. This is even as new orders in the ISM Manufacturing Survey, that is the blue line, has been moving down, which is kind of a break from the historical pattern. If you zoom out a little bit, where cyclical stocks typically move fairly closely in line with new orders. Maybe, Romaine, this is the stock market seeing something that survey respondents don't, or anticipating something that survey respondents haven't yet experienced.
Yeah, the price action doesn't lie, and you certainly see where the interest is. The question is the conviction still there? Michelle Weaver joining us right now to kick us off to the close, U.S. thematic equity strategist over at Morgan Stanley, and she joins us here in Studio 2. Great to see you, Michelle.
Thank you for having me.
Let's talk about that rotation, because even though we have a pretty significant down day today, including with the Russell lagging, we have not necessarily seen people abandon that cyclical trade or the idea that a cyclical rotation will start to broaden out and will start to encompass more participants. Are you seeing that?
So we still have faith in our cyclical call. After the Fed cut 50 basis points and we got stronger labor data, we decided to rotate into cyclicals over defensives. I think on the defensive side, you have valuations that are quite stretched from here. Defensives are still heavily owned, so we think that the risk-reward setup is not great. You're also seeing earnings revisions breadth start to fall within defensives. On the cyclical side, we think the market is no longer concerned around a hard landing the way we were in the summer when defensives were working out very well. So we think we're going back towards that soft landing camp. As you said, the Mag 7 has struggled, so we think the cyclical pocket of the market is really the place to be.
That's what I'm curious about, as to how much of that is tied to the idea of economic conditions being stronger. And we heard from Steve Schwartzman gave an interview with Bloomberg overnight where he talked about this idea that in his mind a recession is off the table, even pending whatever happens with the election and public policy. He thinks we've averted that for now. You're in that camp.
Absolutely. Our economists are still very much within the soft landing camp. They think we're going to get another 150 basis points of rate cuts coming in 25 basis point increments from now through June. So we still fully believe in the soft landing.
You know, Romain talked about how people are reluctant to do much of anything because we're getting ever closer to the election. How much of the shift towards cyclical that we've really seen pick up steam of late has to do with the Trump trade? I mean, we've got industrials and financials as your cyclicals.
Absolutely. I think some of it has to do with the Trump trade. In 2016, really, no one was expecting a Trump win. The market was not positioned for that in any way. So I think the market's now trying to get ahead of that a little bit, considering a Trump win, thinking it's more within the realm of possibility. Is it completely priced into the market? I don't think so, but I also don't think we could have the same huge degree of upside that we saw in 2016 after that win. Like you're talking about, today was a pretty volatile day, but we're really in the zone for election-related volatility right now.
And as people try to price out what tariffs might mean, is it something that you can look at from a top-down perspective, like, oh, this will be bad for chip companies, this will be bad for consumer companies, but it'll be good for financial companies? Or do you have to go from a bottoms-up approach?
So somewhat from the top-down approach, we've found that consumer goods companies are really the ones that would be substantially impacted by significant incremental tariffs on China. Consumer goods companies, the average name within the space, have around 20% COGS exposure to China. So they could see pretty substantial earnings downside if we come out with a much stronger China tariff.
I am curious, when we come back to the U.S. and this idea of the health of the consumer, a lot of that has to do with the perceptions that consumers have. We spoke with some of the guests earlier this week, who talked about this idea that holiday spending is expected to be worse than it was last year. People are looking for a lot more bargains. And despite this idea that the companies themselves, meaning the retailers themselves, are more bullish on the economy, that hasn't necessarily translated to the view by consumers. How do you reconcile that?
So I think it's still a very challenging environment for the average consumer. And I think there's a bit of a disconnect between the way the media or people see the news speaking about inflation and what you actually feel when you go to the store. So people hear on the news, oh, great, inflation's coming down, prices are not going up as much as they were. But when you go to buy something, things are still a lot more expensive than they were a few years ago. And that's absolutely weighing on people and weighing on their decisions on what they're going to buy. We've seen consumers become increasingly choiceful in what they're buying. We've seen travel hold up really well, live experiences, people still value that. But within the goods space especially, people are being very discerning and they're not going out and spending indiscriminately.
Then to sort of circle all this back to this idea, though, of structuring a portfolio for whatever new era we might be heading into. I mean, going beyond the election, even going beyond 2025, are you in a position right now to make strong recommendations for reallocation right now, or do you just stand pat with what you have?
So like I was talking about before, we still really like cyclicals. We're overweight. We overweighted financials as part of our cyclical upgrade. We do have some defensive balance there. With utilities, they're also exposed to the powering Gen AI theme. So that gives us some defensive balance with another popular thematic element. And then on the underweight side, we're broadly underweight the consumer-oriented sectors. We're underweight consumer staples, and then we're underweight the lower quality consumer cyclicals. All
right, Michelle, great conversation. Great start to the show. Michelle Weaver, U.S. thematic equity strategist over at Morgan Stanley, kicking us off to the close with breaking news now crossing the wire.
Yeah, we have Siemens is said to be in talk to acquire the software group Altair. We'll get you more details as they cross, but you can see Altair Engineering right now up about 4.5% in intraday trading.
All right, a lot more coming up here on the show. We're going to take a closer look at Starbucks, an interesting kitchen sink, if you will, preliminary report out of the company overnight. We're going to follow the stock reaction and, more importantly, follow their guidance into 2025.
And CME also reporting results this morning that show strong volume in the third quarter, but with October volume trailing by about 4%, we discussed the current quarter with the CEO, Terry Duffy.
And do you like earnings? Well, you're going to get a lot tonight after the bell. At least a dozen important companies scheduled to report once we get to those bells, including none other than Tesla. Stick with us. A lot more coming up here on the big program. This is The Close on Bloomberg. Welcome back to The Close, happening right now, right here in New York. JP Morgan and Robinhood are hosting their annual investors conference where they have a lot of major key speakers. It includes JP Morgan CEO Jamie Dimon, Rubric Capital's David Rosen, and quite a few others pitching actionable ideas in the investing tech business and policy space. Joining us right now, fresh off the Robinhood stage, is Dennis Jean-Jacques. He's founder and chief investment officer of the hedge fund Ocean Park Investments. And he joined a lightning round panel a little bit earlier at the Robinhood conference. No lightning round here. I think we're going to take it a little easier on you. Yeah. But we do want to talk a little bit about what you pitched on that stage. And I know you and Ocean Park have had a big focus on industrial stocks. And we've been talking, we started off the show talking about this sort of cyclical rotation that appears to be underfoot. And I'm wondering if that's a rotation that's going to benefit the industrial stocks that you've been having your eye on.
Well, I think one thing people don't really understand is that the industrial area is really the unsung backbone of the American economy. And I think that there's a secular change that's going on. I mean, if you look at right now, we're just starting to spend about $1.2 trillion with the infrastructure right now. We have another $52 billion that's been allocated for semiconductor plants and things of that sort. And not one new semiconductor plant has been built yet in the United States. Mm-hmm. You have $400 billion in renewable energy through the Inflation Protection Act. Mm-hmm. Not one new plant has been built in that area. Look, in the U.S. today, we need about 7 million new homes. Yeah. And if you look at the construction going on, it's going to take another 5 years. So there's a secular tailwind that I think a lot of people don't fully understand and realize.
And I don't think most investors would disagree with that. We've been talking about this for a while. It feels a little different this time because it feels like people are more committed to it. And we've certainly seen that in the AI space and the sort of the search for renewable energy or energy sources here. What gives you the confidence, though, that we will see more of a follow-through on that thesis this time around?
Well, let's take an example. Let's look at Mueller Industries. Mm-hmm. Here you have a company where it's an $8 billion market cap company. It's followed by one analyst on the street, according to Bloomberg.
And Mueller makes?
Mueller makes basically, they make wire tubings, they make certain really key materials for industrial companies. So it's everywhere. So whether it's in the homes, defense spending, energy conversion, so they're basically everywhere. All these bolts and things that basically keeps everything together, they basically make all those kind of products. They use brass, they use copper, they use plastic, they use all sorts of things. So they're really the underpinning, yet it's a big company. They have plants all over the world. Yeah. Yet only one analyst covers this company, and this is a phenomenal company. They have net cash on their balance sheet. If you look at the replacement value of the business, it's at least $52 a share. I mean, I could go on the financials, but the key is that you find a lot of these industrials because people believe that tech is where everything happens. Right. But if you look at certain industrials like Mueller, like United Rentals, Vertiv, if you compare them to the FANG stocks, they've outperformed the FANG stocks for the last 5 years. And I believe that in the next 5 years, you're going to see them outperform even more.
You see them outperforming the FANG stocks over the next 10 years after outperforming over the last 5 years. But when you look at industrial companies, you've limited them to a pretty small group. We're talking 10 to 12 names as opposed to, 20 or 30 or 40. Why limit yourself to this small coterie?
Well, it's really about risk management. So the good thing about industrials is that you could try to analyze what the downside is, what Ben Graham would call margin safety. So with companies with hard assets and cash flows, you could get a sense in terms of, if we were to liquidate this company and just sell the land, what is it worth? What's the plant worth? If I melt down the plant and turn the metal into golf clubs, how much can I sell them for? Mm-hmm. So I think that's a very, very key point. Mm-hmm. And for us, we run a low net opportunistic strategy. In other words, we basically become more long when the markets are dislocated. Okay. Now, when the markets are dislocated, I know that we're having a good day. Maybe the markets start being dislocated today. But when the markets are dislocated and there's fear in the markets, it's kind of like what Buffett said, you want to be greedy when others are fearful and fearful when others are greedy. When you're looking at markets when they're being dislocated, you want to be able to find the names where you could have some sort of downside, so you could at least try to quantify, well, how low can this stock really go? Mm-hmm. And to answer your question, with industrials, you could at least get a sense, can I quantify the downside. I cannot do that for software companies.
Yeah.
Software companies seem like they only go way up, and when it goes down, who knows? I can't do that for banks. I cannot do that for biotech companies, and so I find some kind of solace in industrial companies.
I know you're super focused on industrials, but are there any other sectors that start to appear like industrials, offering the same kind of fundamental value, and the fact that they're unloved and kind of left behind by investors who are chasing the big gains of FANG stocks?
That's a great question. So we focus on industrial-related companies. So because there's a lot of other companies that people would not put in the industrial bucket, but we consider them industrials.
I see.
Semiconductor companies. If you're making chips, we think that's more or less semiconductors. Cell towers could be more industrial-related companies. So there are other companies like that we believe, as long as we could identify the downside risk, that's the first thing that we focus on. What is the downside? And if we cannot quantify the downside, it's not even a beginning conversation for us.
All right, bringing it back to the basics then. Jay, Dennis, Jean-Jacques, thank you so much for joining us today.
Great, thank you for having me.
He is founder and chief investment officer at Ocean Park Investments. Also, just a quick note that Bloomberg is partnering with the Robinhood Foundation to launch a charitable stock picking competition aimed to engage clients. This competition starts in November and it will run for 6 months. If you're interested, find out more information at robinhood.org. Now, coming up on the close, a rocky time for fast food restaurants. Next in Top Calls, we'll talk about investor concerns dragging down shares of McDonald's and Starbucks. This is the close.
Let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we're going to start off today with Chewy. Needham's Bernie McTernan reinstating coverage of the online pet retailer with a hold rating after previously having a buy. McTernan says dominating the space, not an easy walk in the park for Chewy when you've got competition from the likes of Amazon, Walmart, and Petco. While Chewy's investment in vet care is intriguing, he believes that's too small to matter at the moment. Investors selling off by about 3% here on the day. Next up, Snap, an upgrade to outperform over at JMP, with the analysts saying the social media company is reaching an inflection point on growing engagement in the U.S. and North America. That's in turn driving greater advertising figures, and artificial intelligence also adding to that performance. Snap earnings out next week. The shares up today. And finally, let's move on to McDonald's. Not a whole lot to love about the shares today. Baird cutting the fast food giant's rating to neutral. This after the CDC's warning of an E. coli outbreak that has sickened some customers and led to at least one death. Baird saying that the stock is facing elevated risk, making it difficult to find near-term upside. A 5% drop on the day, back below 300, and those are some of our top calls. We want to stay in the restaurant space, if you will, and turn to Starbucks. They released preliminary sales numbers last night and not necessarily good. As a result, Starbucks withdrew its fiscal guidance for the year, and newly appointed CEO Brian Niccol now calling for that turnaround strategy. I think investors are too. Let's see what the analysts have to say as well. Chris O'Cole joining us right now, managing director over at Stifel. He's keeping that buy rating on the shares for now. All right, Chris, this isn't a total surprise. New CEO comes in, he takes a look around, throws out all the garbage, if you will, and says, give me a few months, I'll figure it out, I'll have a plan for you. Are you on board right now with what you've seen out of Brian and what you've heard out of him in his short tenure?
I am. We expected the fourth quarter sales in the U.S. to be soft, so I don't think it was too surprising. We believe that the comments that Brian made on the video that the company posted are zeroing in on all the issues. We think that, a big opportunity here is to simplify the menu, remove some of the off-brand items, and really focus on coffee and espresso-based beverages. And it sounds like that's what he's looking to do.
I am curious about that, and I heard him articulate that. I also saw an interview that he did with another news organization where he talked about this idea of making the Starbucks stores, I guess, more comfortable, if you will. The idea that now a lot of these stores have basically effectively switched to basically just takeout operations, and I think he wants to bring some of that magic that I think Howard Schultz had sort of had back in the 90s and early 2000s, where you went to Starbucks and you stayed there.
That's right. And I think a big part of that is improving the work experience for the employees. You'll have more engaged partners If you can simplify the menu, simplify the operations, I think that's going to allow them to be more engaging with the consumer and the guests that come in.
You know, I look at Starbucks shares, and they plunged, of course, yesterday in after-hours trade, and they did open lower today, but they have since moved to the upside and are just up 0.2%. Remain like to call the announcement yesterday, or pre-announcement, kind of a kitchen sink announcement where they threw everything in there and said, you know what, we're starting from scratch here. Have investors' expectations been reset if the stock is little changed right now?
So I think investors' expectations have been reset. I think the margin that they reported yesterday, or pre-released yesterday, the impact on the margin with the lower earnings, I think is an expectation that people now have that is going to be more reasonable going forward. But I think one thing that may have surprised investors initially was that there was really no earnings guidance or investment levels that they plan for 2025. I mean, a lot of times we were hoping they would set a guardrail for investors, because leaving it up to investors' imagination can be risky.
Yeah, it can be dangerous. I want to shift gears over to McDonald's, because that stock is sinking and has remained lower following an E. coli outbreak tied to quarter pounders, sickening dozens of people in the U.S. Chipotle, and of course there's a link here back to Brian Niccol, but not so much. It, of course, had its own issues with an E. coli outbreak. What can McDonald's learn from what happened in Chipotle and make sure that it doesn't follow that same path?
Well, I believe the company has taken the correct steps to limit the impact. I know it's too early to really gauge what type of sales hit the company could have, but I think they clearly identified the likely ingredient, onions, that contain the bacteria, and they've removed them from the stores where they were shipped. And that's the important thing, is to contain the situation. And moving forward, I don't think you'll see many new cases that start today. I mean, I think you'll still see people that are infected and that get sick, but I don't think you're going to see any additional new cases from people eating at McDonald's today or tomorrow.
Got it.
So, yeah, I think the difference with Chipotle was it took them several months, even quarters, to figure out what the issue was.
Right, and that didn't work out so well. Chris, thank you so much. Chris O'Call over at Stifel. And I don't know about you, but does this make you think twice about going to McDonald's, or you don't go to McDonald's at all?
Yeah, I haven't set foot into McDonald's probably since, I don't know, like the Nixon administration. But I did run into Tom Keene, the illustrious Tom Keene, a little bit earlier. And you know what he told me he was doing?
Going to McDonald's?
Going to McDonald's.
Oh, my God.
He said he was going to stay away from the onions, though.
Tom Keene.
I don't know if that was fact or fiction. You never know with Tom. But
I mean, he usually hides out in the Xerox room to eat his lunch anyway.
It's true.
Yeah. All right. We've got a lot more coming up on the close. CME also reporting results this morning. It showed strong volume in the third quarter. However, you look at October volume, trailing by 4%. So let's discuss the current quarter and the outlook with the CEO, Terry Duffy. This is the close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. It finally feels like things are happening in terms of price action in the equity market.
Yeah, just not necessarily in the direction I think some people would have wanted it to be. But I think this was kind of coming. This was kind of this coiled spring, and we knew something was going to happen. I think the hope was it would be in the upside direction. But I think this is kind of an effect of the election being really right around the corner, and everyone just kind of saying, let's just hold off for a couple of weeks.
Yeah, well, there's another 2 weeks to go before we actually get anything further. So let's see how it all shakes out. In the meantime, earnings come in fast and furious, and we're sifting through all of them, including those from CME Group, posting its best quarter to date. The Futures and Options Exchange noted strong growth in interest rate contract volumes and growth in retail trading as part of its new client acquisition program. Joining us now for more on this is the chairman and CEO of CME Group, Terry Duffy. Terry, always good to speak with you. Thank you for joining us today. I look at the average daily trade volume that rose 27% year over year with double-digit gains across every asset class. I'm curious how you read this surge. Aside from increased volatility in the month of August, give us your take on what it signals about the degree and the scope of uncertainty, like Romain was talking about, around the election or around monetary policy or anything else for that matter.
Well, Scarlett, first of all, thank you for having me, to you and both Romain. Appreciate it very much, but you are absolutely right. It goes across all of our asset classes, and this is the second consecutive quarter that we have seen growth across all six asset classes here at CME, not only in average daily volume, but in open interest or positions left open on the books of CME Group. That's traditionally never we see that. So people are managing their risk. Scarlett, they have no choice. They need to manage risk. It's a very dangerous place out there if you don't. We look at just some of the recent events with, some of the banks that had issues with duration risk, whether it was Signature Bank or SVB and Republic and others who went out of business because they did not hedge their duration risk. So that just goes to show you how quick the markets can move. And if you assume risk on your own balance sheet in this world, it's a very difficult proposition. So people are using our markets across all major asset classes, from our ag products all the way through our rates business, as you referenced. So it's a very dynamic time for us here at CME Group.
What about the fourth quarter so far? It looks like volumes in rates and energy look pretty good according to analysts, but there's less activity in equities. Do you expect to make that all up once we get clarity from, say, the election, or will it require a series of events?
Scarlett, I think that when you look at, especially the first couple of weeks of October, I should say, they've been a little slower. When you look at some of the geopolitical events that you referenced at the top of this interview, I mean, they're not on the front page right now, even though they still exist. So whether it's Russia, Ukraine, whether it's the issues in the Middle East, whether it's China, Taiwan, you can just go along the litany, a list of things that are going on in the world. We haven't heard a lot about them, but yet they're still there. So people have a tendency to sit on their hands a little bit, and it's a little bit quiet. Some could say it's the quiet before the storm. We don't know. We also don't know what the Fed is going to do. There's about an 85% probability that there'll be a 25 basis point move in November, but there's others that are suggesting maybe that's not the case. Originally it was 100% probability that where they were going to move, and it was a 50 bip move. Now, so there's so much uncertainty that I think there's a little bit of a wait and see, and you referenced the November 5th election date, and there's a lot hinging on that because the policies and divergence of opinions between the candidates couldn't be greater.
Well, let's stick with that whole idea of policy, Terry. As you know, of course, there's been a lot written about some of the ambitions to maybe try to wrangle some of the dominance out of CME. Howard Lutnick, FMX, of course, looking to maybe potentially do clearing overseas in London. You're still the 800-pound gorilla, whether it's in the futures or cash right now. Do you anticipate that if there is a change in administration, and by change I mean a Republican-controlled White House, that we could actually see a little bit more of an embrace of this idea that Lutnick has put out there to move some of that stuff overseas?
Well, first of all, I would think that Mr. Lutnick, who is co-chair of the Transition Committee, would have to be very careful about conflicts of interest. I think there was a story written about that today out there about potential conflicts of interest. And the President of the United States, whoever that may or may not be, whether it's Vice President Harris or former President Trump, I think the last thing either one of them would ever want to do is to export the oversight of the largest debt market in the world, which is U.S. Treasury debt. There's $27 trillion of outstanding Treasury debt today. And in that, which is really interesting, the futures market is larger than the cash. We're 13% larger on an average daily volume of notional value for that marketplace. We just had recent legislation come out of the Treasury Department for mandatory clearing of cash treasuries, as you're aware, that gets implemented in 2025 and 2026, respectively, for repo. That jurisdiction goes under the exclusive jurisdiction of the SEC.
Yeah.
So if, in fact, the United States is so concerned about that, how could they not be concerned about a market that's actually larger than the one they're just mandating that be cleared and overseen by the SEC. So to me, there's a lot of issues out there, and it's about the resolution authority. It's not where the money's kept. It's not anybody's being duly regulated in UK and the US.
I understand that, and I understand that you guys have proven your chops and to be able to do this and to do it efficiently and consistently year after year after year. Have you had conversations at all with the SEC, with the Treasury, or anyone in the current administration on this topic?
Right across the board, I have, Romaine. I mean, I'm not shy about it. I've been to the Treasury multiple times. I've talked to Secretary Yellen. I've talked to the undersecretaries. I've talked to the SEC chair, the CFTC chair. I've talked to senior members on the Hill on both sides of the aisle about this and the importance of this product, what it means to the participants, the people of the United States of America, and how we have to make sure that we oversee our own sovereign debt. We'd be the only nation on the planet that does not oversee the laws of our own sovereign debt if we were allowed this to happen.
Terry, did you get a sense from these conversations that there will be or they're looking to have a resolution on this before the next administration takes office?
I'm not sure if there's going to be a resolution or not, Scarlett. I do believe that there's a lot of interest in this right now. And, you know, I'm not bashful about saying that I've been very vocal about this because I truly believe in it. And one of the things that I've said publicly, Scarlett, is if in fact that the London Clearing House under the ownership of the London Stock Exchange wants to reopen its U.S. entity and put those products in here under the guidance and oversight of the U.S. government, I don't have a problem with competing with anybody that does that. But that's not the case here. The resolution authority would go to the Bank of England, not to the U.S. Treasury Department, and they're the ones issuing debt. This is so different than anything else we've ever seen in this country.
All right, Terry, I'm afraid we're going to have to leave it there. Really appreciate you taking time for us. Terry Duffy there. He's the chairman and CEO of CME Group. All right, before we go to break, we do want to take a moment here to acknowledge the life of John McGowan. He was a giant in the world of finance who we learned passed away yesterday. McGowan was a self-described anarchist and data dog and is best known for creating the first ever equity index fund while working at Wells Fargo back in 1971. His impact on the industry was vast. Some of the research he did became the backbone of Vanguard's flagship S&P 500 fund. The Wells Fargo division he headed would morph into the ETF pioneer iShares, now owned by BlackRock. And his decades of work at Dimensional Fund Advisors spawned a debt default detection tool that now forms the core of Moody's Analytics. John Andrew McGowan was born on July 17, 1934, and he leaves us this week at the age of 90.
It's time now for our stock of the hour. It's actually a tale of two airline stories today. Spirit Airlines and Frontier taking off after the Wall Street Journal reported the pair have revived their merger talks. On the other hand, Boeing continues to be hit by headwinds. The plane maker reported a third quarter loss of more than $6 billion. But the real focus is whether striking factory workers will accept a contract offer and put an end to their month-long strike. Here now to discuss all of this is Bloomberg's Abigail Doolittle. Let's start with Spirit and Frontier. Is this tied in any way to Spirit getting a bit of a reprieve, extended deadline on refinancing its 2025 bonds?
It could be. They do have a little bit more time. They have a lifeline on those bonds, so they're a little bit more attractive to Frontier. And of course, this is not the first go around. These two had been talking about a merger in 2022, but then JetBlue won out. At that time, Spirit's stock was $32. It's now between $2 to $3. So at this point, if a deal does go through, Frontier is essentially getting a 90% deal or sale on the shares of Spirit. That's one way to look at it, even though it's up more than 100% this week, the best 3 days for this stock going back to 2011.
I'm curious, is there any insight into sort of why they feel like they need to restart, or not that they feel they need to, but why that what sort of scuttled this deal the first time around, which was obviously a lot of issues of cost and regulatory concerns. Has something changed?
Well, Frontier ultimately was beat out by JetBlue. Spirit wanted to go with JetBlue.
And JetBlue,
that was antitrust issues. In this case, it's less likely that that would be the case because Spirit has a little bit more than 200 Airbus planes. Frontier has a little bit more than 100. So together they're going to be, let's call it, 300 to 400 planes.
But don't they share a lot of the same routes?
They share a lot of the same routes.
Because the whole argument with JetBlue was like, we don't overlap on routes, so there shouldn't be any antitrust
But they
concerns.
can divest those planes. Yeah. At least this is what Jen Rhee has, and George Ferguson from BI, both of them have told me. They can divest them to, say, Allegiance. The other thing is Jen Rhee, our antitrust litigation analyst with BI, who I love talking to her. I think that antitrust is so interesting. She was saying in this case, Spirit could also say that they're a failing company or a flailing company, and for that reason alone, that they should be allowed to go forward.
And maybe there'll be a change in the regulatory regime anyway by the time they move forward.
Very good point.
I want to bring in what's going on with Boeing. Came out with results, but that feels like the secondary story.
Yeah, the results don't even matter. I mean, I think that the one thing that came out with the results, although we already knew this, CEO Kelly Ortberg, very strong, basically saying that he's putting in this long turnaround. It's a four-pronged plan. Cash burn is an issue. But at the end of the day, it's all about this strike. Will it end? Officially, it will end. Apparently, the vote will be taken 5 o'clock Seattle time, 8 o'clock here. But we're probably more likely to know the results around midnight. It seems as though many watchers and experts around this expect the deal to go through, that they will get this 35% raise, the 401k match. But who knows? We don't know until the very end.
Do you think that's could be, though, a potential catalyst for the stock? I mean, not so much the terms of the deal, but just the idea that that's off their plate.
100%. Excellent point. Absolutely. Because then they can get back to the business of turning around this company. And then he's saying right now they can't focus too much on new planes. They've got to take care of the debt and the financing and all these other issues. But at the same time, have their eye on the future. This will allow them to do that.
All right, Abigail, taking a closer look here at our stocks of the hour, a closer look at Boeing, and a closer look at Spirit Air as well, as we continue to count you down to the closing bells. We're going to get back to the U.S. market in a moment, but we do want to go out to Sao Paulo, Brazil, where Bloomberg is hosting its Bloomberg New Economy program at the B20. Bloomberg editor-in-chief John Micklethwait sitting down right now with Microsoft co-founder Bill Gates. Let's take a listen.
Well, there's certainly a number of countries, including the United States, where both the public attitudes and the level of investment in nuclear fission are quite positive. You know, at the COP28, a lot of countries came together and talked about tripling nuclear over the future. So that's very different than going into decline. There's a big challenge, though, which is those third-generation plants. They have a lot of pressure. They're very expensive. They're very complex. So there's a question, can we get to this fourth generation? And so you have a number of companies trying to usher in much simpler designs, including the one I'm involved in called TerraPower. There's several other companies doing that. But yes, the fact that the tech companies want to be customers for green energy, and at least for a period of time, they're willing to pay a bit of a premium. And as the volume of reactors go up, then that premium goes away. That is extremely helpful to reboot the nuclear industry around these fourth generation plants.
There is an issue, though, isn't there? That a lot of the attention has been on small modular reactors or kind of reviving old ones rather than building big new ones. Is that a problem? It looks at it from the outside, but I don't know.
Well, if you get small, you can do a lot of your labor off-site, which is advantageous, but it also means your efficiency is a lot less. And so the approach TerraPower is using is to have a medium-sized reactor, 345 megawatt electric. In our roadmap, if utilities do want big ones, those are somewhat more efficient. But first we want to build dozens of our medium-sized reactor, and we've been able to move some of the labor off-site, although we still have some on-site. But size, it's very tricky to get the efficiency as you get small, because it's the kind of the volume of the reactor is your value and the surface area is your cost. So different people are taking different approaches, and of course we have digital design and simulation that is letting us build far, far simpler plants than ever before.
What about fusion? I know it's a question I think I probably ask you once every 5 years. Do you think that it always seems to be 5 years away, or at least that? Is it now getting closer at all? There have been one or two people recently suddenly saying there's possibilities.
Yeah, so Breakthrough Energy, where almost all my climate work is, and I'm the largest investor in, We funded 4 different fusion companies. The one that's furthest along is pretty fantastic, called Commonwealth Fusion Systems. That's a spin-off essentially from MIT, and they're hard at work building their prototype facility outside of Boston. And so it's, you could say it's about 6 to 10 years behind the 4th generation fission. But it has a lot of advantages, and over time it could be even less expensive. And so we're backing these companies, and they're even using very advanced software to simulate how they work. So in the long run, fission and fusion will be a substantial part of power generation, complementing the renewables that are being built at high speed.
Can I just contrast, because you've sort of alluded to it a couple of times.
And we're listening right now to Bill Gates, of course, the co-founder of Microsoft, speaking with our editor-in-chief at Bloomberg, John Micklethwaite. That's out at the B20 Bloomberg New Economy Forum. You can continue to watch this on your Bloomberg terminal. Just type live go, and you can not only hear the rest of that conversation, but all the rest of the conversations on tap at that event. We do want to bring things back here to the U.S. and back to the U.S. market with just about 10 minutes until those closing bells. And the good news, Scarlett Fu, is we are well off the lows of the day. The bad news is we're still setting up for what could potentially be one of the worst sell-offs that we've seen in at least 6 or 7 weeks.
Yeah, and the first 3-day loss in a long time. Big tech, including all 7 Mag 7 names, are lower. And of course, this comes right before Tesla reports earnings after the close, which we will get to. But you have stocks down, you have bonds down, and yields are moving up once again, 4.25% on the 10-year. Rising yields hadn't hurt stocks really all that much up until this point, but maybe starting now, it's starting to bite.
Yeah, 4.2 right now on that 10-year. Your VIX back around 19, traded above 20 on the day. The dollar also elevated. You put it all together, and you do get a sense here, particularly with election risk out there, of why some folks are maybe wanting to sit this one out for a few more days. Richard Weiss, pleased to say, joining us right now here in New York City. He's the CIO of multi-asset strategies over at American Century Investments, which I'm told is you're normally out there way on the West Coast. Great to have you here.
Thank you very much. Glad to be back in my hometown.
And you brought some relatively good weather for New York, at least this time of year. So you're welcome. We do what we can to accommodate all of our guests. Accommodate us for a second and help us kind of make sense of what we've been seeing in the market really over the last few weeks, because we were hitting record highs, and there's no sense here that today's sell-off is anything more than just maybe a modest blip here. But are investors convinced? Do they have conviction in that rally, in those record highs that we had leading up to today?
I would guess it's waning at this point, the conviction. Scarlett just mentioned it. It's yields popping up. This is a concern. The Fed lowers rates. The economy's still running strong. You know the story here. And so long rates are moving up. That's not necessarily a good thing. Combination of inflation, maybe growth scares, economy stronger than expected, and also potentially a credit risk factor, right? The U.S. deficits and debt issues. So not good news. I certainly wouldn't tell you I predicted it, but I don't think this is a big surprise that there's some sell-off. Yeah. And I wouldn't be surprised if a sell-off continues in some form through the rest of the year.
It gets to this idea, though, too, that if you're looking at the market and you think it's overvalued, or you think some of the risks that you laid out could sort of weigh on valuations, is there a case to be made for some of those stocks that had gotten left behind this whole time, or is that just going to make it worse for those names?
No, I don't believe so. I think that's a great point, Romaine. Diversification, right? Rebalance. If you've been fortunate enough to ride this Mag 7 wave, or just the S&P wave, which has been maybe a 1 in 100-year event here in terms of our outperformance versus EFA, emerging markets, small versus large versus small, et cetera, et cetera. I think diversifying, rebalancing back into some of these ignored, arguably undervalued sectors, whether it's small cap, whether it's some of the value defensive sectors, and we've seen, of course, utilities. Surprised to see utilities now matching tech year-to-date returns, right? Financials, real estate, which has been in the doldrums forever, now coming back. I think that's the smart play. Rebalance and diversify. Take your profits from the Mag 7, from the S&P, even move it into an S&P equal-weighted portfolio.
What counts as a safe haven or defensive now? Because big tech became growth and a safe haven. Utilities, which is your conventional safe haven, has become growth because of the tie to AI.
Sure. Well, Cash, always a standard bearer in that regard, still yielding a pretty decent return.
That's the $6.5 trillion in money market funds.
Ergo. Gold and silver, of course, precious metals, but they've run up, 30-40% this year. So arguably maybe not as safe as one might think. The bloom's off the rose on that one. I'd say cash, but as odd as it may seem, I think getting outside the U.S. and diversifying into some of the non-U.S. areas because of the potential weakness of the dollar going forward and what's going on. I mean, let's face it, we have two candidates who, in sweep scenarios, are promising everything under the sun in terms of spending, fiscal stimulus. And I'm not sure either is going to get their way, depending on who wins. But if they were to get any part of that, it's going to be inflationary. I don't know how they're going to be able to finance that. Not good for the dollar in the longer term.
Yeah, not good for the dollar in the longer term. But in the meantime, it's doing pretty well. You look at how it's performing today, for instance, and it's certainly holding within a certain range. What will be the catalyst for investors to finally pay attention to this deficit, debt burden, long-term structural issue?
That's the $64,000 question. Valuations and some of the longer-term trends, I think they tell us or inform us which way to lean, but the timing is the trickiest part. All I have to offer is it's going to happen on a Tuesday. I have no idea what the exact catalyst may be. I think watching the currency markets may be the effect. To your point, the reason the dollar's up, because we have higher interest rates, strong growth. But again, once it becomes a credit problem, maybe Fitch comes out and downgrades us again. I'm not really sure.
A lot of investors, though, at least the ones that are wedded to the U.S. market, are banking on the idea that we won't be as bad as the rest of the world and that somehow that will keep the money flowing, particularly from outside the U.S. into the U.S. Do you buy that argument?
Not in the intermediate or longer term. Now, the momentum can ride for a while, right? Again, I don't pretend to know when to time it. But momentum is very fickle, turns on a dime, and it will reverse. It's investment gravity at some point. This whole notion of U.S. exceptionalism, and I'm not talking about morally or socially, I'm talking about the stock market.
Financial returns.
Just won't last. The outperformance of U.S. over EFA, emerging, all the other markets, is, again, a 1 in 100-year event. It just won't last, never has.
And I believe you. I'm going to ask you a question that you probably can't answer. But what does that unwind look like? Like, is it going to be a violent, volatile market crash? Or could we have something akin to an economic soft landing, but meaning a capital market soft landing, if you will?
Right, a slow bleed where the returns may still be positive, which they certainly are, but the outperformance of non-U.S. equities versus U.S. So I think it's a relative issue.
So like a Japan's lost decade kind of thing?
That's where I would go with it, as opposed to an all-out calling for a crash of some sort.
Yeah, and I take it, I'm just going to assume you're not doing any bets around the election specifically, right?
Never do.
You're not hedging, though?
We do not recommend, and certainly don't do in our own portfolios, make bets with investments on the elections. In horse racing terminology, it's a parlay bet, the trifecta. You have to know who's going to win. You have to be right on that one. They have to be able to implement the policies they say they are, which may or may not happen. And then third, and this is the hardest, the market can have already discounted it, right? Which they're pretty good, pretty efficient at doing that. So to be right on all three of those, that's the trifecta of bets. Just avoid.
That's experience speaking.
Yeah, absolutely. Rich, always great to have you, and great to have you in the studio. Once again, Richard Weiss, he's CIO of multi-asset strategies at American Century Investments, counting us down to these closing bells. Those bells now just about 3 minutes away, Scarlett, with an S&P 500 down 1% on the day. The NASDAQ, that's your big laggard, down about 1.5%.
Yeah, I'm kind of surprised that the Russell 2000 is hanging in there, in that it's not falling more than the NASDAQ. Usually when you have a sell-off like that, you see the violent reaction in the small caps.
Well, to Richard's point, too, I mean, we did see some bids today in the real estate space, particularly with a lot of the REITs. We saw it into some of the financials. Obviously, some of that a little bit more higher weighted in the Russell relative to some of the other indices. So maybe that's helping things out just a little bit.
Yeah, definitely. And we talk about the stronger dollar. I'm always surprised at how much the dollar, how resilient it is, even when people are calling for it to decline.
Yeah. I mean, I'm not trading in my dollars yet for euros. I don't know about you, but we'll see. All right, we are moving closer to these closing bells. Our full market coverage of all of the day's actions, that coverage, it starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through the closing bell, a global simulcast. It starts right now. Tim Stenevik joining us in the radio booth. Carol Massar has the day off. Katie, the horse whisperer, Greifeld, filling in for her today as we welcome our audiences across all of our Bloomberg platforms. And that includes our partnership with YouTube. Katie, you picked the wrong day to be here.
I am thrilled to be here, actually. I hear we have a really busy earnings schedule. We, of course, are waiting for Tesla, and it's a big down day in the market. Guys, we have so much to talk about.
It's not just Tesla, but, Tesla is certainly the focus. We got T-Mobile, Western Union, Whirlpool, Lam Research, Viking Therapeutics, IBM, Las Vegas Sands, and more, Scarlett.
Yeah, it really feels like the election is getting closer, too, with so many people trying to put on Trump trades or talking about it in a way that they weren't just 2 or 3 weeks ago. It's kind of interesting, too. Yesterday, we were talking about this idea of those back-to-back declines that we saw in the S&P. First time that happened in 6 weeks here. But, of course, now we're setting up for a trifecta of declines. And depending on how things shake out over the next, 45 seconds here, it's possible the S&P could drop 1%. Again, something it hasn't done in about 5 weeks or so.
So what would that mean if that does happen?
I don't know. You tell me.
Well, we've had this sort
out?
of relentless rally over the last 6 weeks, right?
Yeah.
We're up more than 20% on the S&P 500 for the year.
And you give back 1%?
Give back 1%.
Yeah, absolutely. I mean, you're right. I mean, at the end of the day, this is a blip. I guess the concern is, does this turn into something more?
Yeah.
Is this just people kind of moving to the sidelines in anticipation of the election and not wanting to be exposed? Who knows? Or it's a shift in momentum, and those are things that you only realize after the fact. Absolutely. Here, as we get the closing bells here in New York, and again, I just want to reiterate this here. This is not panic on the street. You had a healthy number of stocks that did move higher on the day. We'll get to those in a second. But the aggregate effect of what we saw today was red across the screen. The S&P is going to avoid that 1% drop. Remember, it hasn't had a 1% move up or down since at least September 19th. It's going to finish the day down today by about 0.9%. It's 0.92%. Tim Stenevik, I know you're precise. In that case, we round down to 0.9. The Dow Jones Industrial Average, the Dow Jones Industrial Average down 0.96%. We'll just round that up. That's a 1% drop. The Nasdaq Composite down 1.6%, and the Russell 2000 going to close out the day down 0.8%.
Okay, rounding with Romaine, I want to look at the S&P 500. You had 182 stocks move higher today. 316 stocks, Scarlett, moved lower.
Yeah, not a lot of need to round off the numbers here when you look at the sector performances. The worst decliners all down by at least 1.4%. The best performers, REITs and utilities, so rate-sensitive sectors, each up by 1%.
All right, let's look at some of the companies that ended up moving higher today. I do want to start with Spirit Airlines, ticker SAVE. They jumped, reaching their highest intraday level going back to August. The Wall Street Journal reported that Frontier Group Holdings is exploring a renewed bid for Spirit Air. Wall Street was positive on the news, saying that a combined Frontier and Spirit would create a stronger low-cost airline, potentially challenging larger rivals. Look at that, shares higher by 45% today. And AT&T, ticker T, they moved higher after the company gained more mobile subscribers in the third quarter than analysts expected. Shares rose 4.7%. The company added 403,000 net new monthly wireless phone subscribers. Analysts were looking for 394,600. That's according to data compiled by Bloomberg. And finally, Texas Instruments shares rose after the chipmaker reported third quarter results that beat expectations, up 4% today. They did give that disappointing forecast, but the third quarter results overshadowed those. The CEO said there's not much left in inventory correction. That's about time for a rebound, though one hasn't been seen yet, Katie.
All right, let's get to some of the decliners today. Plenty to choose from. I wanted to start with NVIDIA, of course, having a down day.
So I'm just going to interrupt you for a second. Since Tim was going all in on AT&T, why not talk about T-Mobile a little bit?
Because they're doing earnings now.
They actually just came out with their earnings, just crossing the wire. Their third quarter numbers on an adjusted basis, $8.24 billion in terms of EBITDA. That's a beat on the street. Postpaid phone ARPU, $49.79, a metric that a lot of folks pay attention to. That's also a beat on the street. Total revenue, $20.16. And the bottom line, $2.61 a share. Those are all your 3Q numbers, and they all beat the guidance for the full year. The company saying that it anticipates that its full year core adjusted EBITDA, a lot of qualifiers here, but they're looking at $31.6 to $31.8 billion, which is just right around, Katie, what the street was looking for.
And you can see the shares now firmly moving higher. It took a second for traders to decide what they wanted to do, of course, with that guidance raise. Currently higher by about 3.6%. The bar was already high for this company. T-Mobile shares shares up almost 40% year to date through today's close, now moving higher, Scar.
Yeah, it's interesting, especially with Verizon reporting revenue that missed estimates because people were not necessarily upgrading their phones. That you have T-Mobile, which is the smaller rival, giving a forecast that really encourages a lot of excitement about where it stands.
Yeah, T-Mobile CEO Mike Seibert saying that delivered another quarter of industry-leading results, our best third quarter postpaid phone net adds in a decade, record low third quarter churn. It translated to outsized financial results and empowered to raise 2024 guidance yet again, Romaine.
Tesla earnings now crossing the wire. Third quarter adjusted EPS, 72 cents a share. The street was looking for 60, a big beat on the bottom line. On the top line, $25.18 billion in revenue in the most recent quarter, relatively in line with estimates. The street on average was looking for 25.43. Gross margins at 19.8%, well above street estimates of 16.8%. And cash flow in the most recent quarter also coming in, guys, well above the street estimates, $2.74 billion. The street was looking for 1.6.
Yeah, so big beat there, especially when it comes to adjusted EPS. I'll just read that again. 72 cents. The estimate had been for 60 cents in the third quarter. Tesla also expects slight growth in vehicle deliveries in 2024. And you can see that reflected in the shares right now, moving higher. It's been a really, really rough ride for Tesla this year, but shares currently higher about 5%.
And the number that everyone's paying attention to is gross margin. Gross margin 19.8% for the quarter. Analysts were looking for something just under 17%, 16.8%. We'll need to back out what it looks like when you look into just the automotive gross margin x the regulatory credit. What analysts are looking for is something in the neighborhood of 14.9%. Tesla also expects slight growth in vehicle deliveries in 2024. This is after third quarter deliveries was seen returning to growth. So this is encouraging, certainly, for those who are looking for Tesla to recover.
I'm trying to make it through the third quarter update deck here. It says that the company, despite sustained macroeconomic headwinds and others pulling back on EV investments, Tesla remains focused on expanding its vehicle and energy production lineup, reducing costs, and making critical investments in AI projects and production capacity. They say, we believe these efforts will allow us to capitalize on the ongoing transition in the transportation and energy sectors.
All right, I'm going to jump in here and just take us away from Tesla for a moment and look at Lam Research in the semiconductor space. First quarter revenue was $4.17 billion, higher than what analysts were looking for. Adjusted EPS of 86 cents, also topping the average analyst estimates by a nickel. The stock right now moving up in after-hours trading as we await any kind of outlook.
Mattel also crossing the wire right now. Their bottom line, a big beat on third quarter adjusted EPS, $1.14. The street was looking for 94 cents. Top line sales, $1.84 billion, just a touch below what the street was looking for here. Gross margins also coming in above estimates. And here's your guidance going forward. The company says it sees full year adjusted EPS in a range of $1.35 to $1.45. The street on average looking for $1.44 here. And the company now saying that it is looking to try to find a way to cut costs here to boost profit going forward.
All right, I also want to bring us Las Vegas Sands, just a flurry of earnings, and you take a look at adjusted EPS coming in light in the third quarter, coming in at 44 cents. The estimate had been for 53 cents when it comes to net revenue as well for Las Vegas Sands in the third quarter, coming in at $2.68 billion. That is light versus estimates of about $2.79 billion. You add it together, shares currently off about 3%. Las Vegas Sands missing on several estimates there. All
right, I'm looking at Whirlpool shares unchanged in the after hours right now. The company still sees fiscal year free cash flow about $500 million. That's just shy of estimates of $513.3 million. Sees fiscal year revenue of about $16.9 billion. That comes in above estimates of $16.7 billion. Third quarter net sales coming in just shy of estimates at $3.99 billion. And then third quarter ongoing earnings per share coming in above estimates at $3.43. Once again, shares unchanged in the after hours.
All right, and a quick mention here of Viking Therapeutics as well. Third quarter revenue was $0 compared with $0 the same time last year. That does match analyst estimates. We need to look into that a little bit further, but this is a company that also lost money. Loss per share was 22 cents. Analysts were looking for a loss of 25 cents, so it was narrower than anticipated. The cash and cash equivalents, important if you're not making any revenue, $50 million in the quarter, up 35% from a year earlier.
All right, let's take a quick look at Western Union. Shares not doing a whole lot here, but the numbers are out in line on the revenue side at right around $1.1 billion. EPS relatively in line at about 46 cents a share on an adjusted basis. And the company saying that it's standing by the full year forecast that it had previously given on operating margins and adjusted EPS. Katie.
All right, let's also look at Raymond James. Just an embarrassment of riches here. Fourth quarter adjusted EPS, it beat estimates, actually. Adjusted EPS for the fourth quarter coming at $2.95. That's a big beat versus the estimate of about $2.43. Net revenue for the quarter at $3.46 billion, also ahead of estimates of $3.31 billion. You can see shares not really moving too much. Of course, traders chewing on that, deciding what to do, but fourth quarter adjusted EPS does beat estimates.
All right, we got shares of IBM down 3.3%. The company's third quarter revenue came in below estimates at $14.97 billion. Estimates were for just over $15 billion. Third quarter operating EPS came in above estimates at $2.30. Third quarter free cash flow coming in just shy of estimates at $2.06 billion. All right, guys, lots of earnings. We're looking at what's going on with Tesla. Shares are surging in the after hours. Taking a look right now, higher after the company said it expects slight growth in vehicle deliveries in 2024. Shares up after third quarter adjusted EPS also beat estimates. We're going to continue our coverage on radio, on TV, on YouTube. Same place, same time tomorrow. This is Bloomberg.
All right, let's keep the coverage going here on Bloomberg Television. A lot of stocks moving in the after-hours trade. IBM, Align, Las Vegas Sands, some of your biggest decliners, but the biggest mover to the upside here in the after-hours trade, that belongs to Tesla, up about 7% after beating on the top and the bottom line, providing guidance here that also seems relatively bullish, and even giving an update on that Cybertruck, saying that they did achieve gross margin a positive on that truck, and now they plan to sequentially increase production on that vehicle. Seth Goldstein, equity strategist and chair of the Electric Vehicle Committee over at Morningstar, joins us right now to talk a little bit more about what's going on. And there was a lot of talk over the last few months here about maybe EVs were falling out of favor, not just Tesla, but overall. We heard from John McNeil yesterday on this very program, who formerly worked for Tesla, formerly worked for Lyft, formerly worked for Cruise, saying that EVs are still being embraced by customers. And at least based on the results we saw out of Tesla today, that seems to be the case.
That's exactly right. We saw Tesla return to growth with deliveries, and we see Tesla is ramping up its new vehicles. So the Cybertruck is going to be ramping up production, and Tesla is still on track to deliver the new, more affordable vehicle in the early part of next year. And then we got a positive announcement from GM yesterday saying that they are still bullish on EVs and that they will be producing them and think they can make them profitable. So, I think what we saw is a temporary slowdown in EV growth, but generally EVs are still growing and consumer demand is still there.
The company, Tesla, saying that it is on track to open that mega factory over there in Shanghai. And to your point, Seth, on the EV side, particularly on a more affordable EV, they are saying that they plan to launch those affordable models in the first half of 2025. And I want to get your thoughts on this, because this has been a big bugaboo. And I think a big reason why a lot of investors started to sour on the EV trade is that a lot of these vehicles were just out of the reach for a lot of folks. Great if you had $100,000 to spend, but if you didn't have that to spend, you pretty much had to go hybrid or even gas. Is that going to change in a meaningful way next year?
I believe so. I think with Tesla, GM, Ford, and Hyundai all launching new, more affordable vehicle models that will likely come in below the average selling price in the mid 40,000 of new autos in the U.S., then I think we're going to see more consumer demand, where you have interest rates also coming down. So the monthly payment to consumers is more in reach for the majority of consumers who are in the affordable vehicle market. Historically, EVs have been a luxury vehicle, but as we see more new models at a lower price point combined with lower interest rates, we're going to see more of that affordable vehicle demand in things like the full-size sedan market. So think of like the Toyota Camry, or something like the SUV, the midsize SUV, something like a Honda CR-V or Toyota RAV4. All of a sudden, we're going to see EVs in these markets where we have not really seen those before at an adequate range or with the technology that consumers demand.
Another reason why the stock is moving higher in after hours trading is the profitability metrics, right? The gross margin, automotive gross margin, when you back out the regulatory credit, came in at 17.1%. Seth, analysts were looking for something in the neighborhood of 14.9%. How sustainable is this?
I think it's very sustainable. Remember, we had Tesla having multiple headwinds that led to the temporary decline in gross margins for the first half of the year. They were ramping up the Cybertruck. That was still not profitable from a gross margin standpoint. Now we're at break even, likely turning profitable in the coming quarters. We had higher raw materials costs that were still flowing through, and their raw materials costs have been declining. And then we had declining deliveries, meaning higher fixed costs per car included. As Tesla's lowering their costs, and as they've stopped slashing prices like they did last year, we're seeing gross margins start to rebound. And it makes a lot of sense that this is going to be the trend for Tesla going forward, meaning that the first half was likely the bottom.
And I mentioned the gross margin ex regulatory credit. We should mention as well that Tesla trolled the other car makers for being behind on meeting emissions requirements. In fact, Tesla notched its second highest quarter of regulatory credit revenue. The number was $739 million for the quarter. Have investors underestimated that as a source of revenue strength for Tesla?
Well, it certainly helps, and it helps drive positive free cash flow and allows Tesla to maintain a very strong balance sheet with a strong net cash position. And so I do think Tesla will likely still see regulatory credit revenue for the next several years, at least, as other automakers still have to buy credits to meet their standards.
I am curious, Seth, going forward, when we talk about the broadening out of the EV space beyond just Teslas. I mean, for a while, that was the only really viable EV that you can buy. That changed in a big way over the last couple of years. But we've seen a little reticence by some of the legacy automakers about how much they want to keep investing in this and how fast they want to go. Are you confident in the commitment that GM, Ford, and I guess to a smaller extent, some of the Japanese and Korean automakers might have in really pushing deeper into the electric vehicle space?
I think so. I just think it's not going to be as instant as we're seeing in, say, Chinese automakers that have been pivoting very quickly and going all in on electric vehicles. I think your companies like Ford and GM are taking a step back and wanting to make sure that these vehicles can be profitable and that they're not going to end up having to take out a lot of debt because they're selling unprofitable vehicles, when they want to make sure that consumer demand is there, meaning they need to hit the lower price point. You know, just serving the luxury vehicle, we've seen EVs become somewhat saturated. So I think Ford and GM are smartly looking at this and saying, we're going to serve the market, but only when the costs make these vehicles profitable for us to do so. And I think that will happen in the next couple of years.
You know, I'm looking at the share price right now, and even with this big boost up, it's still not back to the levels it was before Robotaxi Day on October 10th, when Tesla didn't quite deliver on the details. Seth, what will you be listening for on the conference call today? I mean, it probably won't be more detail on Robotaxi because they would have told us already on October 10th.
Yes, exactly. I would be looking for more detail on the full self-driving, because to get to robotaxis, we need to start where we are today, which is the full self-driving supervised. At the Robotaxi Day, Tesla did say for Texas and California, they plan to launch the unsupervised full self-driving software next year. And so I want to hear more about what adoption metrics look like in those markets. I want to see more about what their plan is for FSD miles, how that's going to be training, if the Jojo supercomputer is taken over, because that would lead to faster AI training and a faster improvement on the FSD product that would ultimately potentially get you a robotaxi version. But I'm hoping to hear more details, not just the timeline, since Elon Musk set a 2026 timeline for robotaxis, then joked that he's bad at setting timelines.
All right, good stuff. Seth, really appreciate your joining us. Seth Goldstein is equity strategist at Chair of the Electric Vehicle Committee at Morningstar with the latest on Tesla's results. We also have earnings crossing right now for ServiceNow, the enterprise software maker, reporting third quarter adjusted revenue of $2.79 billion, higher than what analysts had been looking for, adjusted EPS of $3.72, a big beat over the consensus estimate of $3.46. And this is even as the fourth quarter subscription revenue is also higher than what analysts were looking for, and the full year subscription revenue. But Romain, as you can see, the stock down in after hours trading.
Yeah, the growth rate's coming in well below those whisper numbers here. We're going to take a deeper dive when we come back into some of these earnings, including ServiceNow, including IBM, including Lam Research, and quite a few others. Stick with us. This is The Close on Bloomberg.
Season is here.
I think that this earnings season is going to be so important.
Bloomberg is first to break the numbers.
NVIDIA earnings now crossing the wire.
Bank of America, the retailer Five Below.
There is something for everybody.
With the smartest insights.
Weaker inflation is not great for earnings.
I think the consumer's a bit more resilient.
You've had earnings recessions flow through growth and then cyclicals and defensives.
Earnings cycle continues on Wall Street.
Continuing coverage on Bloomberg. Context changes everything.
We are wading our way through a wave of earnings. So let's get you a roundup of some of the big movers right now and bring in Bloomberg's Abigail Doolittle, Emily Grafeo, and Alexandra Semenova. Abigail, let's start with you.
Okay, I'm taking a look at the shares of Whirlpool, which have reversed a decline that was on the day right now, up nearly 5% in the after hours. They missed sales, but they beat earnings. The big deal here, though, is after a lot of options activity going the wrong way, there was a lot of put action ahead of this report. They really maintained the guide, and in fact, they even boosted it. For sales, they're looking at $16.9 billion for 2025 and 16.7 versus the estimate of $16.7 billion, and then $12 in adjusted earnings for the year versus a range that was less. One note that I would like to say, though, they're also saying that the weaker sales in the quarter that was show some shopper reluctance or buying bigger ticket items around the election, that there's a quote unquote negative slant. Even so, though, again, that earnings guidance and that overall revenue guidance brought higher. So these shares responding well. Emily, what are you looking at?
So I'm looking at shares of ServiceNow, actually pairing losses because the stock was down as much as about 5% in the post market, now nearly down 1%. They did beat on both third quarter revenue, EPS, and they also beat on their full year and fourth quarter subscription revenue. This is an enterprise technology software company. So unclear exactly what is driving the losses right now. They did have two other pieces of news, though, right before the earnings crossed the wire. They're going to have a new president, COO, and Chief Product Officer. That'll be Amrit Zavery. And they're also going to be expanding a partnership with NVIDIA to map out AI agent use cases. Curious to hear more about what exactly that means. I think showing here that the bar is a little bit higher now in earnings. You can't just say NVIDIA and expect a big stock pop. Alex, what are you looking at?
Hey, Emily, I'm looking at shares of Lam Research, the chip equipment maker, beating on most metrics and growing its revenue again last quarter, of course, thanks to the demand for artificial intelligence technology. Revenue came in at $4.2 billion, slightly above the roughly $4.1 billion expected by Wall Street analysts. Its outlook also coming in above estimates. You could see here the stock is up more than 5% in after-hours trading. Now, this report is a much-needed reprieve for investors, given how much pressure the stock has been under in recent months. Shares had been under pressure, of course, following weak guidance from ASML and reports that the U.S. is considering export restrictions to countries, including China. The stock has been a leading decliner in the chip space, of course, underscoring the divide between winners and losers in the $500 billion industry. It's down roughly 40% from its July high and down 7% year to date. The implied move from our options markets was about 6% post earnings. We'll see how that plays out tomorrow, guys.
All right, thanks there to Alexandra, Emily, and Abigail. A closer look at 3 of the more than 24 major companies reporting earnings after the bell, and that also includes IBM. Shares of the IT services and consulting company down about 5% here in after hours trading, 1% roughly growth on the top line here, but some concerns here about infrastructure revenue, which was down, consulting revenue, which was down, financing revenue that was down. Anurag Rana over at Bloomberg Intelligence joining us right now to talk a little bit more, I guess, about whether you found any bright spots in this report.
Yeah, going into IBM, we were expecting software revenue to pick up, and it has improved slightly, and consulting to be weak, and which is exactly what happened. So from our sides, at least the fundamentals were where we were expecting it to be. So I'm a bit surprised about the stock reaction because everybody knows consulting is an area which is under pressure right now. That's the non-AI part of IT spending, and software doing slightly better.
So, I look at the overall revenue number, 1% growth in the third quarter. Earlier this year, 1% in the first quarter, 2% in the second quarter. Are the days of mid-single-digit revenue growth that we saw in the second half of last year just over for IBM?
There is a bit of currency, also over there. So when you strip that out, it's roughly around 3% or so, 2 to 3% going into the last few quarters. It seems to me that going into the next quarter, we are looking at some kind of, you could say, pullback in more discretionary IT spending, which is not surprising given the elections, given the macroeconomic conditions, geopolitical concerns. But having said that, I think there could be a rebound next year back to that, mid-single-digit level that you're saying.
Let's talk about the AI side of this company, roughly about $15 billion in revenue. And the company right now saying that its generative AI book accounts for about $3 billion of that, up from about $1 billion the previous quarter, Anurag. Should we continue to see that number grow?
Yeah, and remember, those bookings are tied mostly to consulting. So, people sign that deal, but over the next 12, 24 months, that converts into revenue. So you're not going to see that $3 billion translate into revenue quickly. It may take some time. But that's also, we think, 70 to 75% of that is skewed more on the consulting side rather than on the software side.
Is IBM going to need to go out and make purchases when you consider that the software sales got a big boost, up 10%, driven by the growth in Red Hat? It continues to pay off. Is that where it needs to go to buy that growth?
Yeah, I think the IBM story is all about software. And, we'll assume that the HashiCorp deal goes through by the end of this year. It's really going to help them with the software growth next year as well. We did some numbers around, and I think the street numbers for HashiCorp are a little bit low right now. Their execution's been well. I have to give full points to IBM for making that pivot towards software, and I think that's going to do well for them in the long run.
Can we extrapolate the results that we got out of IBM today, Anurag, and extrapolate that for maybe some of the other big tech companies that are on tap to report over the next week or two?
Yeah, what we do expect that AI-related spending is going to be good. Infrastructure software should be good. But when you look at some of the other areas, such as application software or consulting-related work, we think there is still going to be pressure on that over the next few months.
All right, Anurag Rana, one of the best in the business over at Bloomberg Intelligence out there in Chicago, a deeper dive into the results out of IBM. Those shares moving slightly lower here in the after-hours trade. Maybe some concern here about what's going on in the consulting business, Scarlett, and maybe just the overall pace of growth. As you said, 1.5% growth on a major tech company doesn't quite get you in the Mag 7.
No, tech and growth go hand in hand, but that's not the case if you have 1% revenue growth, right?
Absolutely. And we're going to continue our focus here on tech stocks. We're going to get back, of course, to those results out of Tesla. But before we do that, we want to take a look at Apple and look back in history at the debut of the Apple iPod and its lasting legacy on the music industry. That conversation coming up after the break. Stick with us. This is The Close on Bloomberg. All right, let's take a quick look back at this day in history. October 23rd, 2001, Steve Jobs, Apple, introducing to the masses the iPod music player. It was the company's first venture into the world of handheld electronics, and no, the Newton does not count. The iPod was a truly portable, standalone device, a device that would lay the foundation for the iPhone, for the Apple Watch, for AirPods, and the wide array of mobile products that now dominate Apple's lineup. The magic of the original iPod was that there really wasn't much magic to it at all. Effectively, it was just a miniature hard disk drive with a click wheel control wrapped up in a sleek-looking case. Great. But the key selling point was the amount of storage. Jobs, in his usual bravado, said that the iPod would put 1,000 songs in your pocket. This was a huge upgrade over existing music players at the time that were touting storage of roughly 64 megabytes. That's the equivalent of about 1 to 2 hours worth of music. You compare that to the iPod's 5 gigabyte hard drive, which was good enough to store more than 60 hours of content, and it was no contest. And Jobs, he managed to do that with a device that was smaller and about half the weight of competing players at a cost of $399. Only about 300,000 units were actually sold, though, in the first full calendar year of sales. A bit of a dud. But as we now know, the iPod, alongside the iTunes software, would dramatically reshape the way people bought, stored, and listened to music, which in turn completely changed the economics of the music industry and changed the financial fortunes of Apple, which was struggling at the time to broaden its product lineup as demand for PCs slumped. By 2005, annual iPad sales had went from, well, the tens of thousands to the tens of millions. Apple would release dozens of versions of the iPod over the years, but the concept of a standalone portable music player, that would eventually be eclipsed by improvements in the company's other device, the iPhone, which led the company to begin phasing out the iPod models in 2014, and by 2022, announcing it would cease to make them anymore at all.
So if you have one, you should hold on to it because it's basically a museum piece at this point. The iPod really paving the way towards streaming and away from buying and owning your own music. All right, we're going to stick with the technology sector and take a look at shares of Tesla rising in after-hours trading after the EV maker reported results higher than expected profit and projecting a slight increase in deliveries for the current year as well. Joining us now to discuss is Tasha Keeney. She is Director of Investment Analysis covering autonomous vehicles at Ark Investment. Tasha, I know that as a firm, you are bullish on Tesla, and this was a very positive earnings report overall. What part of it surprised you or impressed you the most?
Yes, well, I think, the street's going to be most surprised by the profit figures. Of course, EPS came in higher than expected. Gross margins ex credits, which is an important figure for many. Also, a few whole percentage points higher than expected at around 17% for the quarter. So they achieved, the letter is very focused on their cost reduction efforts. And that's great for, those short-term concerns. Long-term, we are focused on the future of the company, which is autonomy and robotaxis. So we're seeing higher full self-driving software revenue recognition. That tells us just how useful these active safety features are. And of course, we know that next year, Tesla plans to unleash an unsupervised version of full self-driving, which means that it's just a matter of time before they can launch a robo-taxi service. Mm-hmm. I think that's an opportunity that's worth over $10 trillion globally. And Tesla really could be the first company to scale here.
How literally do you take what Tesla says in terms of its projections on what it can do when it comes to these long-term plans? Because a lot of people do take what Elon Musk says very seriously and literally, and then you have something like Robotaxi Day where it's long on hype and short on detail, and then they're disappointed.
Scarlett, I love this question because I think there is so much focus on the short term, and there's actually a lot of misunderstanding about the robotaxi potential that it actually offers an opportunity for investors. So AI is notoriously very hard to time. We're not going to know the exact day that a breakthrough is going to happen necessarily. But at Ark Invest, we're long-term investors. We're focused on a 5-year time horizon. So do I think that within the next 5 years, Tesla can launch a robotaxi service? Yes. So that is what we're focused on. I think that, again, what they did announce is that they're launching unsupervised full self-driving next year. We know that from Waymo that autonomous taxis are a reality today, so it's possible. It's just when will Tesla release one? And again, I think Tesla's much better set up to scale because of its data advantage and its advantages of being a vertically integrated manufacturer than a company like Waymo, which is Google's efforts. So I think that means that they're so close to robotaxi launch that this could happen in the next 2 years, and it'll totally change the business model of the company. So might that be off by 6 months? Could it be delayed? Absolutely. But I think, that's why we put a band around our forecasts at Ark Invest. And I think the important thing is whether or not it'll happen, and we think it will.
I guess the question, though, I have on that, and assuming we do get to that, where you get the regulatory approvals and we can see these things on the roads here, we know Tesla has the scale to really ramp up production on these should they get that approval here. Is it going to be cost effective? Are they already there where this is going to be a cost effective proposition?
Yes. So we know from the Robotaxi Day that Elon said that they think they can achieve at scale a cost per mile for robotaxis of 30 to 40 cents to consumers. That's a very disruptive event. And that's because the cost to drive a personal car in the US today is around 70 cents. The average cost of ride hail like Uber is around $2 per mile. So at that point, it's a lot lower than today's human-driven ride-hail prices, and it's even cheaper than driving your personal car, meaning the market for ride-hail will expand far past what we see it as today. So at first, Tesla's competing with Uber, but long-term, they're not. They're creating a market where they could be a player with winner takes most advantages because of the scale, not only in production, but in data. So Tesla announced that they've over 2 billion miles cumulatively have been driven in full self-driving. We think they have access to over 5 million a day. That compares to just 70,000 at Waymo. That's a dramatic advantage.
I know you're looking way, way long term, and we could get to a point on a regulatory basis where these are everywhere. But right now, we're still only seeing these, at least on the testing phase, and just a couple of cities, and even in those cities in certain areas. As this expands out to more cities and to a much broader swath of those cities here, how long does it take where we will see these, say, in all 50 states, or at least in every major city where these would be viable?
Well, I think within the next decade that this could be the dominant form of transportation in urban centers. And again, our focus is on the 5-year plus time horizon here. So I think, we think this could add trillions of dollars to Tesla's market cap because it is, a business that will have much higher margins than the base auto business. It's software as a service like margins here. So this is an opportunity that really shouldn't be overlooked. So I think that there's a lot of doubt right now, and that investors, are concerned that until they physically see Tesla on public roads with an autonomous car, that it may not happen. But again, Waymo's proved that it's possible, and I really think you're asking the right question, which is when will it scale? And I think the player to scale it is Tesla.
All right, Tasha Keeney talking about how Tesla has that first mover advantage and it will be the first to turn that into a meaningful advantage as well. She is Director of Investment Analysis at Ark Investments. Thank you so much. All right, we want to get you a recap of some of the other big after-hours movers. And these are all companies that reported earnings in the last 30 minutes. IBM lower in after-hours trading after soft consulting sales. This is a non-AI part of the business. Weighed on its results of 1% growth in revenue overall. ServiceNow losing ground as well. It did report strong sales growth and new AI agent, but overall it is declining here. Maybe a lot of enthusiasm about its AI linkage had given it a boost in the weeks leading up to the results. Las Vegas Sands gaining 1.2% on the day, or I should say in after-hours trading, even after its third quarter adjusted EBITDA missed analyst estimates. And T-Mobile gaining almost 3% in after-hours trading, more monthly mobile phone and broadband subscribers than analysts had expected, a higher forecast for new customers and earnings this year.
And we flip up the board here. Let's take a look at the biggest mover in after-hours trade. It might surprise you. It's a managed healthcare company, Molina Healthcare, just out with results here, a beat on the top and the bottom line in a pretty large way. EPS at 601, Street looking for 592, and the company standing by some of its full-year forecast. Newmont Mining, one of the biggest decliners in after-hours trade, after missing on EPS and missing on 3Q sales, and the company saying that going forward here to expect maybe some moderation, and of course coming out of all of the big gains that we've seen in the mining space, particularly when it comes to gold, silver, and copper. Whirlpool shares higher in the after-hours trade on the back of a beat there. Mattel so too, as that CEO continues to cut costs, helping to boost the bottom line. A lot more coverage coming up here on the big program. Stick with us. This is The Close on Bloomberg. All right, let's talk a little bit here about private markets, because top financial regulators around the globe are voicing concern specifically about private credit valuations. The SEC here in the U.S. and regulators over in Europe, as well as at the IMF, all warning about the systemic risk and lack of transparency around those valuations. That doesn't necessarily mean it's uninvestable, so let's talk to somebody who knows a lot about investing in this space. Viktor Hjort is the global head of credit strategy at BNP Paribas, and he joins us today here in Studio 2. Great to see you, Viktor.
Thank you.
Let's talk a little bit about the investability of this space. We've had a slew of guests come in this program, and they always make the bull case for private credit and private equity for that matter. Is there a bear case for private credit right now?
Good question.
The bear case is obviously that you have a default cycle and actually start to generate real losses. And actually, that's the main scenario where you would generate main losses, because it is not an asset class where there is a mark-to-market process. Because there isn't, that's also something that generally makes it hard to value the asset class. If you look at bonds and so on, somehow volatility itself is one of the key risks, not so much in this asset class.
But it is a market, private credit at least, that is to a certain extent beholden very much on interest rates and where interest rates are. And there's been a lot of talk about the Fed's easing cycle, if you believe that's what we're at right now. And for that matter, an easing cycle overseas in Europe as well. Is that going to be a tailwind for private credit, or does that already not matter?
Assuming those rates cuts happen, I definitely think it is a tailwind because it will reduce the level of interest rates that the companies are paying. It will improve their interest coverage ratios and so on and so forth. And, as much as we focus on valuations in the private credit space, I actually think that the fact that this asset class now exists, it starts to affect valuations in the broader public credit market as well. Because you have, if you like, an alternative funding channel for companies that wasn't really there before. And I don't think it necessarily matters so much in a market like today, where financing conditions are great almost wherever you look. But it does matter in times like 21, 22, when we had a lot of volatility, when public market financing channels are a bit tight. It matters that companies have an alternative financing source to go to. And that means that credit spreads may not have to be as wide as they otherwise would, if you like, right?
Because of private credit.
Because of private credit, yeah.
So let me understand, which is the tail, which is the dog? I mean, who's wagging who? Private credit valuations help set the standard for public credit market valuations, or vice versa?
So the fact that it's grown so much, and the fact that it starts to eclipse part of the leveraged credit space, high yields and so on, in size, does suggest that the tail is increasingly wagging the dog. But I don't think it matters, much like today. It matters in these situations where you have big bear markets, where you have a sharp tightening of access to funding. It matters. That's when the fact that you have an alternative funding channel starts to improve valuations in the public markets.
When you look at credit spreads right now, whether it's investment grade or high yield, they're pretty tight, 80-something basis points at least for investment grade. What does that tell you about the environment we're in right now, the appetite for credit?
It's very strong. It is a market which is doing its very best to price in a Fed put. But, the conditions are also super benign. You have a central bank that's willing to reduce rates into an economy which is growing at a very robust pace, and earnings are strong, right? So it is definitely an environment where credit risks are very low, and where and that obviously creates that sort of tailwind. I would argue that valuations are very expensive as well, especially in the U.S. investment grade markets, probably one of the tightest markets out there. And so I think, especially ahead of the election and so forth, that does create some risk.
So where are you committing money? Where is you and your team committing money right now? Are there certain sectors that you're finding more attractive right now in this environment?
Yes. Different parts of the market have absorbed a lot of supply. Autos is one such sector where there has been significant amounts of supply, but where we think that's going to start to tail off, especially after the election. And the results are coming in are very good. The U.S. auto makers are performing much better, for instance, than their European peers. There's much less of the sort of China overhang in those earnings. So we think that the auto fundamentals look very strong, and it's going to have that tailwind of supply tapering off, we think.
But you don't like luxury, and you don't like credit tied to aspirational luxury in particular.
Yeah, absolutely. So the consumer is fine. But at the more discretionary end of the consumer space, that is less obvious. And I think when you're looking at the earnings season so far, especially the luxury space, I think that there's been disappointment, and some of that's linked to China.
Yeah.
But disappointment nonetheless. I think that's an area where it makes sense to be cautious.
All right, Viktor, got to leave it there. Really appreciate you coming in here, flying all the way in just for us from London.
Absolutely.
I'm sure. Viktor Hjort, the global head of credit strategy over at BNP Paribas. As we continue to sort of round out this show here, we're going to come back here and set you up for what's going to be another busy earnings day tomorrow. Stick with us. This is The Close. All right, before we push ahead to what's going to happen tomorrow in the here and now, some breaking news crossing the wire on Transocean and Seadrill, two of the biggest offshore drillers in the world. We're now learning, according to people familiar with the matter, that they are said to be discussing a merger. Transocean and Seadrill could potentially combine, according to these people familiar with the situation. We've reached out to both companies for comment. We haven't heard anything yet. Scarlett?
Yeah, Seadrill moving up in the after-hours trade as a result. All right, we've got a flurry of earnings due out tomorrow, including from shipping and freight giant UPS. The company, in fact, was hit with a rare underweight rating earlier this week from Barclays, which says it faces extreme pressure from rival FedEx and long-term risks from the potential loss in delivery volumes from one Amazon. Joining us now is Brandon Oglenski. He is director and senior equity analyst at Barclays. So there are short-term reasons and long-term reasons to be bearish on UPS. The short-term, I think, is pretty clear after FedEx gave a disappointing print. But talk to us about the long-term, and in particular, the vulnerability that Amazon poses to UPS.
Yes, Scarlett, and thanks for having us on. And look, it's always hard to downgrade a stock during the earnings week here. But again, this is really more on the long-term picture, and I think you really keyed into it there. FedEx is going through a transformation right now. They have these separate express and ground networks that for a long time, operated pretty well from a customer perspective, but from a financial investor perspective, didn't deliver any real returns or any real profitability. As they merge those networks, which they started to undertake about 2 years ago, we actually think they can now match the asset productivity of UPS, which for 30 or 40 years here has run one integrated network, always had better asset efficiency. And the problem we see longer term is that now you're going to have a merged FedEx that's emulating the asset efficiency of UPS. But UPS, all their frontline employees are represented by the Teamsters. Personally, I'm not anti-union at all, but the problem we have is that the merged FedEx is going to be a non-union competitor. Mm-hmm. And if you've been looking at transports over the last couple of years, one of the biggest stories probably in the last year was the Yellow bankruptcy and effectively Yellow liquidating, which was one of the biggest unionized less than truckload providers, versus like folks such as FedEx Freight or Old Dominion, which have done so well without that union work rules and the constraints around contracted wages and pensions. So
this gets to the question, though, is that how do they adapt to that, if at all? I mean, do you see a path where they could either reorganize or reposition the company in some way to address some of those issues, not necessarily the union issues specifically, but just to sort of become a little bit more competitive?
Yeah, and look, I think the market got pretty excited when UPS named Carol Tomé their CEO. This was back in 2020, right? Yeah. When the pandemic was starting. Obviously, we know there was a lot of package demand for a couple of years, so their margins looked good. I think the challenge for Carol, though, and we really like her, and I think the outside perspective at UPS has been very helpful under her leadership. The challenge is I really view her as stuck between a rock and a hard place because on the one hand, you do have the work rules and the Teamster contract that just isn't going away. Mm-hmm. And that's something that she just has to deal with going forward. And on the other hand, you have Amazon as your largest customer. It's about 12% of total revenue. And it's really in the domestic business, so it's close to 20% of their U.S. network. I mean, you can think about that as like almost 1 in 5 packages being your largest customer. They have a big incentive to insource this.
So what is the best case scenario for Carol Tomé and UPS to get through these next couple of years?
Well, I think, she laid it out pretty well at their March Investor Day, effectively saying, look, we need the market to grow a little bit more than it has the last 2 years, right? We had this big whipsaw effect from the pandemic, but if we can get back to e-commerce outperforming GDP by a multiple,
and remain paying for expedited shipping.
That's right. So just get a little bit of tension in the supply chain, get a little bit of outperformance from B2C. You could see a lot of volume come into the system for both FedEx and UPS and even Amazon's delivery network. such that everyone can get a little bit of incremental return here.
All right. Great stuff, Brandon. And of course, we're all keeping an eye on that. Brandon Oglenski over at Barclays. Of course, UPS earnings will be out tomorrow before the bell. Team Surveillance will have full coverage of that. Street estimates looking for $22 billion in revenue, 163 on the bottom line on an adjusted basis. As we push ahead to some of the other potential market moving events, a lot of earnings tomorrow.
Oh my gosh,
Scarlett.
so much. The floodgates have opened. Before the market, we're going to hear from Keurig Dr. Pepper, Northrop Grumman, of course, UPS we mentioned, Southwest and American Airlines.
Capital One, Skechers, Deckers, Texas Roadhouse, some of the names coming after the bell. We're going to get some economic data as well, including those weekly jobless claims.
Jobless claims because everyone's looking at the labor picture, but also PMI numbers and new home sales.
And new home sales could actually be interesting. I mean, I know we don't focus on that as much, but a lot of talk about what's going on there. Your favorite, more Fed speak. I'll save you the pain. Beth Hammock going to be speaking, Cleveland Fed president. And then we could hear from Jensen Huang.
Yes, the CEO in his black leather jacket.
And it's not even earnings day for him.
No, he'll be in Mumbai for the NVIDIA AI Summit over in India.
All right, we'll be keeping an eye on that, and we hope that you keep an eye on us. We will bring you all of the breaking earnings tomorrow after the bell. In the meantime, stick around. All your politics coverage coming up next, right here on Bloomberg.